Hello and welcome to ETBFSI.com. My name is Amol Dete and I'm in conversation with Team Nicolle. He's heading Prima Dollar, a fintech company which is working for the trade finance. Team, welcome on the show.
Yes, good morning from England.
Team, I would like to start with, if you could give us a perspective on how Prima Dollar has positioned itself in the trade finance world. Because I have been talking to a lot of fintechs, but most of them either are operating in payment space or a credit space. Since you're operating in a different space, I would like you to tell us how are you actually, building this product of trade finance, and how are you actually helping the trade finance ecosystem, meaningfully and significantly.
That's a great question, Amal. And I think one of the challenges that every fintech faces is working out exactly what the problem is that they're
Right.
trying to fix. Trade finance is a huge opportunity in fintech. I think it's the holy grail. It's one of the last completely unconquered spaces of the financial universe from a fintech perspective. And trade finance is kind of working, but also broken. So the banks have got very sensible and very well proven trade finance products. They date back actually to Victorian times. The letter of credit, documentary credits, there's a proper and well managed regime for trade finance, which the banks operate. And yet their market share is falling every year. I think down to maybe now only 7% of global trade is supported by a traditional bank trade finance product. And the problem that we see, maybe not everyone agrees with us, but the problem that we think the industry has in trade finance is a customer journey problem. So the bank products definitely work, but they're just not very attractive and comfortable for customers, importers and exporters to use. So the problem that we are addressing here in our services is that customer journey problem. It's delivering the same results that you get when you work with a bank, but delivering them in a much better way. And our services typically can deliver cash to an exporter upfront in 6 steps, compared to a typical banking product, which might take 30 or more steps to achieve the same result.
Yes, Tim, those are the virtual challenges. But yeah, thank you for the opening remarks and answering the question, Tim. My next question is, when you say that, you're offering a low cost trade finance without any collateral, how do you manage that?
Well, so trade finance has got a simple job to do. When an exporter puts goods on a boat, he needs the money, and the buyer should be allowed to pay later. And that's the job that trade finance is delivering. That's its task. So it's always been a product which relies on the creditworthiness of the buyer. So the buyer might be in next door in Bangladesh, or might be across a number of oceans in the US. It doesn't really matter where the buyer is. The purpose of trade finance is to get the exporter paid at shipment and to allow the buyer to pay later. So the good news for Indian exporters is that we don't need collateral and guarantees from them in order to give them cash up front. But what we do need is a buyer whose credit we can take using our international underwriting and our international financial resources. So we already operate in 40 countries. We do something which banks find very difficult, which is working in a joined up way across borders, internationally and globally. So this is something that banks are finding difficult for all sorts of probably good reasons, actually. It's something that we find much easier to do than they do. So therein lies the opportunity. So we don't need collateral from a local exporter. We just need to make sure that his buyer is creditworthy.
And what kind of demand do you see right now? Because the pandemic has disrupted and derailed everything. So what kind of demand do you see coming in from the businesses? How has been the trade finance, shaping up after unlocking the things all over the world?
Asian suppliers, so this is not just India, have been hit 3 ways by the pandemic. So back in Q1, back in March, April this year, there were lots of cancelled orders. And sometimes buyers were even cancelling orders when the goods were already on the boat. Pretty harsh tactics, shall we say, from a lot of buyers internationally. And of course, what that meant was that factories ended up with goods and not cash. And of course, they have in turn borrowed money to make those goods. So it meant in turn, local banks ended up being full on their lines. So the lines were not getting cleared. So that was the first hit. The second hit we all experienced was the shutdown, lockdown, no work, no operation for a few months. And now there's a third hit on the factories across Asia, generally speaking, which is the buyers are coming back, but they're coming back and asking for credit terms. So whereas you might have had a buyer giving you payment at 14 days or giving you an LC back in the old days of 2019, now a lifetime ago, here we now have the buyers coming in and saying, actually, here's my new order, but actually I'd like 120 days to pay, please. And that's simply because of the liquidity pressures in the buyers' home markets are cascading down into the supply chains. So a lot of our clients have had a triple whammy, have been hit three ways by the pandemic, and it's a liquidity crisis which they're facing. And it's not that the banks don't have the money, that there's plenty of liquidity in the banking systems. It's that their local lines are still blocked from the trades that fell over back in Q1 of this year. So now they're coming back to the banks to say, look, I know I didn't pay you back in Q1 because I ended up with the goods. I didn't get the cash, but now I need to borrow money again because I've got new orders to make. But you know what? The buyer's not going to pay now till 120 days after shipment. And this is a major headache for the local banks. So demand for our services is really rocketing. The challenge we have, though, just to be really honest and clear about things, is that it's very hard to write credit risk today. There are a lot of businesses which in 2019 trading environment, so pre-pandemic, are perfectly good businesses, really doing well, profitable, great credit risks we're happy to take. As we sit here today, quite a lot of those companies may not be viable anymore. In Europe, across Europe, we're going into already in second lockdown phases. So there's a lot of uncertainty in the markets. And of course, all the government supports are running out. So we've got companies which have traded or paid their bills over the last 6 months, relying on government supports that we're pretty sure in the first half of next year are not going to be available. And then, as Warren Buffett famously said, we're going to find out who's swimming without any trunks. And so it's actually a very difficult market for trade credit. I think we have to be honest, we have a lot of demand, but we don't say yes all the time, I'm afraid.
So when you're saying, there is a lot of demand, and when you also said that there were really good businesses which got hit or which just, what you can say, swept away with the pandemic, how much is demand back into the action? And how do you see the outlook for 2021 or 2022? How many businesses will be retained?
So we've seen demand leap probably 500%. I mean, 5 times. And we say our acceptance rate in terms of credits we're happy with has probably halved. Whereas before we might have been happy with 3 credits out of 10. Now we're happy with 1.5 credits out of 10.
Right.
But instead of 10, it's now 50. And that's a challenge for exporters everywhere, actually. Those buyers coming back in and asking for credit, they may not be okay for the money.
Okay.
Even if you've been trading with them for 20 years, there are businesses which are completely in trouble. I mean, there are obvious issues with hospitality, with cruise ships, with airlines. These are very obvious casualties of the pandemic because of changing demand patterns and shutdowns and lockdowns. But even just high street retailers are running into trouble in different countries. And a lot depends on how big their reserves are, how big their capacity is, whether they have online models and offline models or just purely offline. Credit is a complicated thing at the moment. And what we can't do, credit, the way credit always used to work was you looked for the trend lines, you looked at the history, you looked at last year's accounts, the year before's accounts, and you judged the management and you made a call. But you know what? Last year's accounts are completely irrelevant now. There is no historical data to base credit decisions on that's relevant today. It's just a breakpoint in the credit process. So every credit decision we make, we have to look at with sort of discounting the history, unfortunately. And we have to look at each business on its merits right now based on what we can see.
Very interesting, Tim. What I would like to also learn from you is how fintech specifically like you operating in trade finance space, because this was dominated by the banks and the large financial institutions traditionally earlier, are making a big difference in this space, which was a very, very traditional and only legacy institutions were working in this space. So how fintechs are actually making a difference in this space? That is point number one. And point number two, as I see a lot of fintechs are rising and entering into different sectors, uh, how important for fintechs to also look at trade finance as a growing area?
There's some realities which we all have to face here. And our job as a fintech is to link money with demand. So the demand is there. The exporters have the demand. Actually, the importers have the demand for trade finance. The importers want their exporters to be happy and they want to pay later. So we are adjusting our model right now. So we have always avoided taking the credit risk on ourselves by using insurance products. So although we've had the last few minutes discussing how we underwrite credit and how we look at credit, which I think is a really major issue, we've never taken the credit risk ourselves. We've always laid it off in the markets. So we've had what we would call a credit light model as a fintech. What we see happening now is a move away from unsecured credit in the markets towards much more sort of relationship-based lending and secured lending. And that just reflects the necessary security which lenders need to hold in order to give credit. And a move away from credit insurance-based trade finance to relationship-based trade finance, which is a different model. We are very lucky. We have a powerful platform which operates our products and connects importers and exporters together. And we've adjusted the way we work so that we're now able to plug into an importer's operations and provide him with a way of using his own funding and his own cash, actually, to support his exporters. And we call this supply chain trade finance. So we've been able to adjust our model to take into account the way the pandemic has hit credit internationally and the way in which funds are flowing, so that we're able to move away from a credit intensive model to a much more connective model where our role changes. So as I said at the beginning, the main problem in trade finance is the customer journey. The banks have got a product that works. It's just very unpleasant and difficult for everybody to use it, and very complicated and very technical. We can, by using technology, we can create a much better and easier relationship between the participants, importers and exporters, and the cash. And so we're adjusting our business to take into account the pandemic. We're not just going to continue driving a bus and go straight into a wall. We can see the market dynamics. And because we have a technology-driven business, we're able to adjust the way we work and redirect the way in which importers effectively participate in providing liquidity to their exporting clients. And supply chain trade finance is the next big thing in corporate treasury and corporate finance for large corporates, internationally, large multinationals. And it's a product that we also are bringing to Indian importers as well as international importers. So, long answer to a simple question. How are we adjusting our positioning here? We're actually moving our business model because technology allows us to do that. We have the flexibility to change the way we're working so that in the end, we're working with secured lenders and relationship lenders of large buyers.
But again, just a cross question, and again, would like you to expect. I mean, I expect a short answer to the long question. But
Oh,
if you
that's
could,
all right.
yeah, just add more on the what kind of difference will supply chain trade finance will make to Indian market, and what kind of scope do you see fintechs to enter into that space?
The Indian market, so large Indian corporates do import a lot, even though you have your Made in India campaign and you have your move towards rupee based invoicing and so on for imports. And obviously you have tough exchange controls, which are rightly there to ensure that dollar cash remains in India. But on the flip side, Indian importers spend a lot of time and money on using traditional banking products because it's very hard for international suppliers, wherever they are, whether they're in Europe or the US or China or Malaysia and so on, to take credit risk on Indian importers. So India has this problem both ways around. It has a trade finance challenge for exporters selling internationally, and it has a trade finance challenge for importers who are bringing necessary raw materials, products, and so on into the Indian market, producing solutions which can work for either end of this challenge. So we're working already with international buyers to implement supply chain trade finance programs for them, which cover all their importers, all their exporters, I beg your pardon, wherever they are. And we're doing the same for Indian importers. So helping Indian importers increase their efficiency by reducing the cost of landed goods and avoiding the use of complex and expensive old-fashioned banking products. And it all adds to GDP in India, whichever way around we look at it. There's no rule that says imports are bad.
Right.
Imports are good, exports are good. It's all good, but we need to improve the efficiency with which it's done.
Agree. Copy that, Tim. And I'm really glad that you shared all that information with us. So thank you so much for your time and sharing the perspective on supply chain trade finance and giving us a perspective on how the Prima Dollar is working in this space. Thank you so much for talking to ETBFSI.com and sharing your perspective. Thank you so much for your time.
No, thank you, Amol. It's a pleasure.